We're here for a sort of a discussion on both life and non-life reinsurance. So along with me, we have Doki and Nell, who will be talking about life, and on the life side, we'll be talking about capital management. And then on the non-life side, we'll have David and Manish, who will be talking about optimizing reinsurance solutions for non-life. First question for the audience. I mean, how many here went to the current issues session, life session in January? Put your hands up. Anybody attend? Okay. So for you guys, unfortunately, my slide deck is going to be almost identical. So if you had too much tea and you have to use the washroom, you can do it now. You can go back now, and that's okay. But don't go for too long, because we have Doki, who's going to talk about a different angle on things. So you can leave now or within the first 10 minutes. So that's okay. I won't be upset. Okay, so first slide is just talking about what's gone on. And as most of you, hopefully most of you know, the regulations changed in India. Beginning January 1st, reinsurance changed, regulations associated with reinsurance changed. So there's now more flexibility in what you can do. You can reinsure to other reinsurers. You can basically do quota share versus surplus, which used to be just surplus. And you can do capital motivated transactions, obviously subject to regulatory approval. Regulatory approval is always very important. So anyway, the environment here has changed, so that allows opportunities to do transactions that the opportunities weren't there before. So again, for my apologies, because again, this is sort of some of these slides have been reused. So capital management's used broadly pretty much everywhere. Reinsurance for capital management is used around Asia. It's used in Europe. It's used in the U.S., in Canada. So it's pretty much a global phenomenon. Reinsurance gets used for capital management pretty much around the globe. And why do companies want to use reinsurance for capital management? And there's a whole bunch of different reasons for that. Sometimes, companies are doing acquisitions. So they're going out, you want to buy a company. You want to buy a company, but, you need some money. You need some cash. Your shareholder is saying, okay, well, I'm a little hard up right now. Otherwise, I'd give you money. You're maxed out on your debt, so you can't go out and get any more debt. So you need money for an acquisition, but where does that come from? And one option is reinsurance. So reinsurance can help fund you acquire another company. So that's one thing. Another thing is volatility. I mean, if things move around, if your income statement moves or if things move, everybody likes smooth. I mean, I like smooth. Anybody here who doesn't like smooth results? No? Okay. So reinsurance can also help smooth the results. It can happen through basically traditional reinsurance, but also capital reinsurance can smooth out your results to make things look better. New business strain. As you write products, you have to pay commissions, you have to pay for things. So new business tends to be kind of expensive, and again, reinsurance can help you here as well. Enhancing your return. Sometimes you have high hurdle rates, internal hurdle rates. Reinsurance can be a cheaper source of funds than your other sources of funds. If you want to go out equity, you're looking at double-digit returns, required returns. Whereas if you use reinsurance, the cost of reinsurance is going to be closer to sub-debt, so you can help leverage your returns as well. One common thing that we run across is basically companies, this is more multinationals. There's two things. One is getting money up, so passing money upstream to your parent. And that could be giving money to your shareholders so they can pay out dividends to their shareholders or to buy back shares. So that's one thing. But the other thing also that reinsurance can be used for is to not just bring money out, but help money come back in. So reinsurance can help you, for capital reasons, can help you in both ways. And the other one is just basically, it's this is the basic one, is pressure on solvency. You know, solvency is a regulatory issue, but things can affect it. Movement of interest rates, poor experiences, various things can happen that can affect your solvency. And again, reinsurance can be used to help your solvency when used from a capital perspective. And when you guys keeping track of the time? So Doki, if I go over, you can come over and tap me on the shoulder. I'm only allowed 15 minutes, okay? So if I go over, if anybody's got things you want to throw, yeah, nothing too big or sharp, but you know, programs, or if you got a candy, you can throw a candy. So yeah, it's important that Doki has a chance to chat. Okay, so why do you use reinsurance? Now, your sources of capital are you can get equity, you can get sub-debt, and in India, sub-debt gets treated as tier 1 if it's a long enough sub-debt. Or you can use reinsurance. So why would you use reinsurance versus other means? I mean, one thing reinsurance does is helps you increase your available capital, but also helps reduce your required capital. Because you are reinsuring business, you're insuring on a risk basis, so it helps reduce your required capital. So that's one thing reinsurance does that nobody else does. Risk is transferred. So again, that gets reflected in your reduction in required capital. So this risk transfer, so if something really bad happens, although nobody wants that to happen, but something really bad happens, then this reinsurance can help you cover that. The other thing is if you have debt, if you write debt and you write sub-debt, then that gets viewed as on your balance sheet, you have debt on your balance sheet. And having a ratio of debt that's too high is a problem. Rating agencies don't like it, you know, shareholders probably don't like it. So sometimes companies just get out and have too much debt. So that means that if they have too much debt and they can't raise more, then that has a restriction on the amount of funding. So reinsurance can be used instead of debt, and it doesn't really show up on your balance sheet as debt. So that's one way to help if you max down on your debt. The other key thing, and I think one of the most important things in reinsurance, is flexibility. Reinsurance can be designed however you want. If you want it big, if you want it small, it's very custom designed, so you don't have to do a big transaction. You know, and also, again, there's a lot of flexibility we capture. So everything is custom designed. It can be done quickly, and it's relatively easy to do. So you know, you can make it fit your need, but if you go out and get sub-debt, you usually have to get a big tranche of money, and if you get it for, say, an acquisition, and then you don't do the acquisition, then you're stuck with the sub-debt. So with reinsurance, you don't do the acquisition, you don't have to, you know, nothing happens, you don't have to worry about it. Reinsurance also can be private. Like if you do sub-debt or do sort of public placements, then that's public and publicly available information. Reinsurance you can do, and it's up to you whether or not you disclose. If you're doing a big transaction, you probably want to tell people about it, but it's more up to you what you want to do. And payback comes from profits. If you don't make money, you don't pay back. So ideally, it's everybody's interest that you get paid back, but otherwise, you don't make profits. You don't have to worry about it. Okay, so you know who likes this sort of stuff? Well, regulators around the region like it. They approve it. They're okay with it. And in India, too, with the change in the regulations, the regulator here has also said this is something that's fine. Now, auditors have to check off things. Auditors have to look at your books and be okay with what you do. And again, in all the regions that these deals get done, auditors sign off on it. So, KPMG, EY, Deloitte, PwC, they've looked at these transactions and they think they're okay. And also rating agencies. The rating agencies sort of see these transactions and are also okay with transactions. So again, you don't have to worry about doing this sort of stuff. It's well known. It's all done by other regulators. It's done by accountants in other markets, and also rating agencies are happy with it as well. So the types of business that you can use for capital management are pretty much the regular sorts of reinsurance that you'd use for other stuff. The first one would be yearly renewable term, or YRT. So that's risk premium reinsurance, and you use that for your regular surplus stuff, but you can use it for capital management as well. And you can do different things with that. Co-insurance and modified co-insurance are slightly different transactions. Probably you don't do many of these in India right now, or you don't do any of these in India. But all this is doing, take a quota share of your business, take a quota share of your premiums, quota share of your claims, and so it's just taking a quota share, so it's very simple. There's variations on this. Co-insurance is where you pass all the assets over. Modified co-insurance or co-insurance deposit back is where the assets are left with you. You continue to hold the assets, you continue to hold the interest on the assets. So these are very balance sheet light in that they don't really affect your balance sheet very much. Okay, so I'm gonna talk a bit about some of the uses for where in some of the markets where these things have been used, how they've been used. So I'm going to go through a few examples, and again, apologies for some of these examples of repetition of things I've shown before. But this is just different illustrations of what you can use reinsurance when you do capital management. So the first market we're talking about is Singapore. Singapore, the reserves are based on, for universal life, is based on the greatest of three things: surrender value, best estimate, or what they call MCL, minimum conditional liability. So the issue was if interest rates are moving the wrong way, your surrender value floor gets hit. And I guess a similar view is in India that you have to think about is your reserves are floored at zero. So there's analogies here that this is something that worked in Singapore that could also be applied in India, because the same issue exists in that you have a surrender value floor that kicks in on a non-economic basis. So the solution we did with this in Singapore was really we got rid of the surrender value floor. So now when the assets move, the liabilities all move in sequence, so it removes distortion on your income statement. And this helps to remove volatility on your income and also your solvency. So this is something that was done in Singapore. And again, how does this fit on the grid? Again, we're talking about earnings volatility management here. So what the solution did is help remove volatility. So again, nobody likes volatility, so the companies were saying this is a problem. So the solution helped remove the issue. Okay, another one is Hong Kong. Hong Kong has quite a interesting way that they do the statutory statements. Their assets can move, but the liabilities they move, but not very quickly. So if you have interest rates move up and down a lot, then that causes solvency issues. So this happened in Hong Kong. So interest rates moved the wrong way, so it generated a lot of solvency issues for them. And as a result, they were having issues. So they would have to get capital from the parent, or they'd have to do something. So this is a situation where we're able to use reinsurance to help them from a capital management perspective. Here we provided funding. Value was locked on in-force blocks of business, so we helped provide funding here, which helped the solvency ratio. So here, a solution was a system on pressure on solvency. Okay, the next one is actually, I could probably hand this over to Doki right now. Do you want to take this? You can do this deal. Okay. This is something that we've both done these transactions. So it's not Doki Slide, but that's okay. I'll hand it over to him because I think I've been talking too long. Can you take it? Did you want this? Okay. So I'll give you the clicker.
This is very similar to my first one. So it's two examples where on the client side they were seeing negative economic reserves, but on the statutory basis they were still holding quite a lot of prudent margins. And so by entering into a full risk co-insurance treaty on a quota share basis, we were able to reduce the statutory reserves that the clients were holding, and that reduced the new business, or that reduced provided them additional flexibility. So the main example I had here was one where the client in Spain wanted to strengthen its capital position, and wanted to generate cash to use for strategic changes in their business direction. And so what the client was looking at was they also had this big negative reserves in their portfolio that they weren't able to recognize. So what Swiss Re did was to pay about 690 million cash to the client to be able to buy into this portfolio. So we then reinsured the book on a full risk co-insurance basis, taking quite a share on the portfolio. So that means in the future we would share in all the future profits and losses that would be generated from this business. But by providing the cash injection to the client and providing this sort of cash injection into the economy, the client was then able to meet their KPI objectives. And in this case, got a very favorable review from JP Morgan that they're able to strengthen their capital basis. The benefit for the client was that they'd received the cash, but then they're also able to continue to pay service their policyholders. So their commitment to the policyholders in the front end didn't change at all, even though they had this sort of back-end arrangement with Swiss Re. So it ended up being a win-win for the client and for the reinsurance company. The second example was an insurance company in Japan that wanted to launch a new business, that wanted to launch a new product with additional protection benefits attached to it. But in order to sort of gain market traction, they also had to pay out a higher commission than average. So this created quite a large reserving strain for them and new business strain, and started to create liquidity concerns for them. So the solution that we offered was, again, on a regional term co-insurance basis. Swiss Re was able to reinsure the business and provide the client with a combination of upfront commission and ongoing commission. The upfront commission and the reserve the release that they got from the quota co-insurance helped to reduce the new business strain. And this ended up being a win-win situation as well. So not only were the client then able to increase the volume of business that they were selling, but for the consumer and the policyholders, this was good because they were getting a new product that was a relatively innovative product in the market, and wouldn't have been able to sell without the support of the reinsurance. The last two case studies are more interesting case studies just to show what other benefits reinsurance can provide in a market. So the first one is on the left-hand side is a longevity swap. So in the UK and the US, longevity is a large concern, but you have sort of two factors that create a concern. On the one hand, there's the longevity risk itself, and on the other hand, there's the investment strategy that's backing that longevity risk. So in scenarios where you have a very long duration risk and you have very low interest rates, small changes in longevity behavior can really impact your reinvestment risk that you're taking on the asset side. So companies were looking to lock in the longevity rates that they were paying, or longevity curves that they were paying, in order to then develop an investment strategy to back that curve. So by providing a longevity swap to the market, we're able to solve both issues. Volatility around longevity, but also giving clients a certainty so that they can then lock in their investment basis when they're backing that with assets. The other solution is a mass lapse one that's quite popular in Europe. So when you have an economic solvency regime, you're able to use some of the negative reserves that you're earning as equity. So the biggest risk that this equity faces then a sudden mass lapse event happening, meaning that the equity falls. And so what you get with a lot of these companies is that the mass lapse required capital is one of the key drivers of your risk capital. And so a solution that the reinsurers offers is one where we reinsure on a sort of stop loss basis lapses between a certain attachment point, typically 20%, and a upper point of, say, 40%. So that then provides you with a reduction in your required capital. And so the reason for showing these two is that, so although the reinsurance is really good at helping to provide you with the initial sort of benefits that helps with reserving requirements, it's also really good risk management tools and help you to manage the volatility through your whole balance sheet on a more complex way than you would by just looking at additional risk premium business. So I think to conclude, the key lessons that we've learned is that one, reinsurance for capital motivated transactions are both flexible and tailored to each specific need. So although there is sort of quite a large variety of these things, they all end up being very tailored to your specific needs and your specific KPIs. The second one is that it provides you with additional tools to manage your risk and volatility in your balance sheet, and with that comes additional balance sheet strength. The third one is that it helps you when you're launching new products or new innovative products for your policyholders. Reinsurance could be a really useful tool to manage the KPIs that's associated with that product. And so it ends up being really good for policyholder protection as well. And then the last one is that we've seen, as Graham mentioned, it's being used as an important tool for capital management throughout the region. And we hope that it becomes one in India as well.
Okay. Great. Thanks very much, Doki. I'm remiss in my job as a moderator. I didn't do my introduction. So Doki is with Swiss Re. He's based in Hong Kong. He's a senior structural and transaction manager. And he does deals throughout Southeast Asia or throughout Asia. Previously, he was with PwC, Prudential, and Aviva, so obviously he has a good experience base. Also on questions, what we're going to do is just wait till the end and do all questions at the same time. So if you have any questions from this session, if you just wouldn't mind holding on to them for right now, we're going to do the next presentation. And at the end of it, feel free to ask any questions you might have about anything. We can talk about the traffic, subways development in Mumbai, anything you want to talk about. So just I'll introduce. So first of all, we're going to have David Manival who's based in Singapore. He's the head of P&C South Asia with Willis Towers Watson. Previously, he's worked at AIG and Aon Benfield. So he'll be coming up and talk. And also we'll have Manish Singh, who's based in India and who's a senior consultant also at Willis Towers Watson. And he's worked at a number of different general insurers and reinsurers in UK, India, and Southeast Asia. So they're going to talk about reinsurance, program design, evaluation, and optimization. So please give them a warm welcome. Thank you.
Thank you, Graham. Could we load the other deck, please? In 1990, Harry Markowitz receives the Nobel Prize for his mean to variance model. Essentially, that's a way to optimize the return of investments or assets. What this means is that for a given profit and a given risk, you can actually increase your profit up to a maximum. When you reach that maximum, you reach what's called inefficient frontiers, and that's being used in banking. Now the question, how do we extend that model to insurance? Be it reinsurance, various sources of capital, underwriting decisions, M&As, are they accretive or dilutive to the portfolios? So to everything that we do, capital modeling as well. But back first to that theory, on the horizontal axis, you have the risk measure, which is, in the case of Markowitz, that's the variance or standard deviation. On the vertical axis, you have the mean profit, also called rewards. So you can see in that example, you're moving from a point B to a point A. For example, point B is 100% bond portfolio. That's maybe the one that some of the companies are holding in the room. Point A, it's 90% bonds, 10% equity. By doing so, assuming that equity has a higher return, you are having a vertical shift whereby you are increasing your profits. In addition to that, in that simplistic example, you are also reducing your risk on the horizontal axis. Reduce risk, increase profit. That's a clear benefit, and therefore you should move to portfolio A in that simple example. Now the difference between finance or investment and insurance is that when you hold an asset in finance, your maximum loss is typically the cost of that underlying asset. If we forget derivative for a minute, but the underlying, that's really what's happening on the underlying. In insurance, you can largely lose more than the premium that you are receiving. And for that downside risk, you need to hold capital. And that capital also requires a return. So that's a fundamental change. So how do we move from a model which is only looking for mean to variance to capital? So essentially, we're moving to 3 dimensions. So here, the mean is being represented by the y-axis, which is called profitability. The variance here is called volatility. Now, there are various forms of measuring volatility. So one of them is variance. Another would be looking at the 1 in 10 year loss. That's something which tends to speak a bit more to insurance companies. But on top of that, we have a third axis, which I've called solvency, but we could have called capital. And fees is another measure of risk. So we have 1 measure of reward, which is profits, and 2 measures of risks, which are volatility and solvency. There are typically 3 types of capital. So you have economic capital, regulatory capital, rating agency capitals. Which one to pick? Typically, that's being determined by the binding constraint. In many of the countries in Asia, it tends to be the regulatory solvency, but not in every single country. So in the example we are going to take later on with Manish, actually we'll be looking at economic capital, but we could have chosen a different matrix for solvency. Now, we can have several metrics, not just one, for example, on capital. An example will be, I want to optimize my economic capital, but really what I need to do on the rating agency part is to be in the A range. So it's kind of binary. It's either I'm in the A rate, I have an A rating, or I don't. So you either pass or you lose. So that's not really a matrix that is difficult to optimize. If you don't pass, you disregard that decision of that reinsurance structure and you move to another one that you hopefully will pass the test. Okay, now in terms of building a model, so you essentially need to parameterize attritional losses, cat losses, large losses. That's step 1. Step 2 is to overlay different type of reinsurance. Now that could be different type of investment portfolios or different type of decision that you would want to consider. The third step is to see what the impact, to essentially run your model or your calculation and to see what the impact on the KPIs, which were essentially in the example that we had earlier on, profit, volatility, and economic capital. And then step 4 is really to decide what's the best decision to make in that example we are going to take next, what's the best reinsurance structure to apply. So I will now pass to Manish.
Thank you, David, for setting the framework for the insurance evaluation. Now we are going to see a practical approach, how we can go about setting this model. Okay, so what we see here is like to start a model, we would need some parameters. So what we have here is the gross loss distribution on the left-hand side, which is split by claim type, attritional and large. And you can see the distribution, different percentiles and the corresponding amounts on the left-hand side. On the right-hand side, there is a kind of a similar graph. It is more from the loss ratio perspective and how the loss ratio contribution at different percentiles. So once you have defined your inputs and you have done a validation, now you have to pass your gross loss distributions through our reinsurance program, which we are going to evaluate. And once this distribution is passed through the program, this is a kind of a sample output that you can obtain from a reinsurance program. So what you see here is the red line is your kind of reinsurance premium by program. And we have ignored commission for this example. The next, the black line that you see is the kind of a total recoveries that is received from the program. And finally, the yellow line is the profit for this particular program. So what we are trying to see here is like you can have various KPIs that are coming out as an example from an insurance program. And once you have these KPIs, you can use them to arrive at a technical price, which can help you to kind of when you're going into a negotiation for a reinsurance purchase or kind of an evaluation, you can sit and say, okay, according to us and as per our experience, this should be the technical price for a particular reinsurance program. Moving forward, so now we are going to talk about, we have done an evaluation of a reinsurance program, how we can extend this program to do a kind of a reinsurance optimization. Definitely we would need a simulation model. That model will answer these questions which is there. So I'll probably I think it is self-explanatory. I'll move forward. So let's try to understand reinsurance optimization from a simple kind of a case study. So what we are planning to do here is we have a kind of a lines of business where we have written kind of a 40 million of premium, and there is assumption about loss ratios for different claims types being attritional, large, and CAT. What we are intending to do here is we wanted to evaluate how this book is going to perform if we have different programs which can be a structured quota share, different kind of excess of loss, and a stop loss. And at the same time, what we are also trying to maintain here is the company is required to hold capital so that they can be solvent in 1 in 200 kind of an event. So this is the background of our case study. Moving forward, in this graph, what you see is if a company doesn't have any kind of a reinsurance protection and they just go with this kind of a business plan, this can be the possible kind of a profit profile for the company. So what you see as a kind of a purple line is your profit kind of a distribution. The yellow line on the right represents the expected profit, and the blue line towards left is your required capital. So, and this dotted line is giving you kind of what kind of a volatility that you can expect in 1 in 10 kind of a year scenario. So now linking back to the previous kind of a framework, so what we have profitability, we have volatility represented by the dashed line, and we have solvency. So all these kind of parameters can be kind of gauged in a typical kind of a program or analysis like this. Moving forward, this is a kind of a return on capital distribution when you go about changing your reinsurance program. You can see a gross profile and how kind of going to a different program can reduce your capital requirement, but at the same time, they can give you kind of a higher return on capital. Yeah, and finally, putting all this thing together in a form of a simple kind of a table like this. So what we have all the different kind of options in terms of gross and the different programs that we wanted to evaluate, and what is the kind of cost of reinsurance that we are giving for these programs. What is the kind of expected profit if we go for these programs, your capital and 1 in 10 loss kind of an amounts, and what is the return on equity. So if a company has all these parameters for different reinsurance program, they can go about deciding which is kind of an important criteria for the company, and then they can clearly go for that particular program. And in this particular example, you can see excess of loss with a kind of a 30 mil excess 5 is turning out to be the best program because it is giving you a kind of a highest kind of a reduction in capital, and it is giving you a kind of a good rate of return. Moving forward, so this is again linking back to the efficient frontier that we talked about. So how, if a company is currently standing in with a gross profile where you have 1 in 10 scenario of around 38.3 is the kind of a volatility that you see in 1 in 10 scenario for the gross program. And if you move from your current program, which is program A, to program B, you can have kind of a higher profit at the same time as a kind of a lower kind of a capital requirement. So this is how you can put all these things into one perspective and then decide. So moving forward, so once you have decided about, okay, which program that we wanted to go with, then the next kind of iteration that can be performed, and that is how you want to balance kind of your return on capital and the required capital. And you can still do another level of optimization by moving your retention level and then looking at what is the kind of return on capital that you're getting and what is the capital requirement. So you can locate what can be the sweet spot where the company wanted to be, and that can give you a further level of kind of an optimum reinsurance program. With this, I would pass over to David again to conclude on this session.
Why is fees important? I don't cover India, but reinsurance is the largest spend, in my view, in India. It's 30 to 40% of the premium. In the example that Manish described, 6 to 7 million can be actually released, either through profits or excess capital. In my experience with my previous insurance employers, we released more than 200 million USD. That's in excess of 14 billion rupees by going through that same exercise. Now, the communication needs to be tailored to the various stakeholders. ROE, people will be asking, I want to improve my ROE. But in fact, ROE is just using two of the metrics that we saw. It's profit after tax over capital. That's just what it is. Other people may want to look, actuaries may want to look at economic value added. That's also derived by the same metrics. It's all related. So, in my view, actually, we got a lot of questions is that I don't have the data or I don't have the right quality of data in order to perform such an exercise. In my view, it's not the main hurdle. The main hurdle is actually to have the right framework and to know what to look at, actually trying to understand what we are trying to improve. We see a lot of metrics being spoke about, but actually it's also good to come back to the basics, to actually understand what is really driving values and how we should be optimizing insurance or reinsurance the same as they do it in finance. Thank you. We will now take questions.
Great. Thank you. Thank you very much, David. So as David says, we're done with the presentation. So any questions from the audience? Anybody have questions about material, or you can ask personal questions to these guys. I'm sure they'd be happy to answer if they're married or single or whatever. Questions? Anybody? Actually, how much time do we have? On time for what? Okay, okay, maybe I'll. Okay, we're on time, which basically means we left 5 minutes for questions. So, unless you're extremely desperate to leave, I mean, I'll ask these guys. So for this sort of solution, you can get I guess quite a sophisticated structure which will help a company, a non-life company, help manage its capital. But the other side of it is you got to talk to the reinsurers. So is it easy on the non-life side? Quite easy. You have a structure that the client wants to do to optimize the capital, and there's easy discussion with the reinsurers to say, okay, this is what our client wants. Can you provide a structure that provides the support for this?
The structure can be complex or simple. Actually, the theory that we describe can be applied both to financial reinsurance and traditional insurance. The main hurdle, again, is actually to know what we are trying to achieve and to be able to communicate that within the insurance companies, knowing that most of the time, and that was my experience elsewhere, is that there's a lack of reinsurance expertise within the firm, usually as an insurer. Plus, you also need to have the right tools. So when actually people know exactly what they are looking for, which is actually a key step, is to define and then sometimes to redirect. So if somebody wants to speak about ROE, the thing is that you can have a small portfolio with a high ROE, you can have a larger one with a smaller ROE, but the difference may just be reinsurance, but the one which has a lower ROE generate more profits, so could end up being better. So we really need to be clear on how to look at reinsurance first. And the second is that it doesn't have to be complex necessarily. So in the previous endeavors, what we just did pro forma financials. So what's the impact on P&L and balance sheet of different reinsurance structures? And this is not a complex simulation or calculation. exercise is actually more of an accounting exercise on understanding what's the impact. And based on that, if you have a certain threshold from which you distribute dividends or excess capital, you are able to quantify the change in that. And essentially what I used to do in my previous company is that actually we increased that numbers and we're able to increase dividends yearly by more than 75 million USD.
Okay, great, thanks, David. So David, I hope when that happened, you got a really good bonus. So that's a lot of money. Okay, so if no questions from the audience, I mean, our information should be available on the website. So if you do have any questions, you leave and you're on the way home and you think, I should have asked this question, don't hesitate to reach out to us. You got contact information, so please do so. So anyway, I'd like to, one more, no questions? Okay. I'd like to take the opportunity to thank our speakers. So if you join me thanking them for their excellent presentations. Okay, I think that's it. So thank you very much for your attention. Thank you for staying here, not leaving. Even the people who had seen the presentation before, they stayed. And what nice guys are these? I mean, they'd seen the presentation, they stayed. I mean, that's really, thanks a lot. Okay, thanks everybody. Have a good rest of the afternoon.